You've worked hard and have finally saved up $1,000. Now you're looking for where to invest it so you don't spend it on the next nice thing that catches your eye. You're to be commended for making that choice. Today we will go through a handful of ways to invest that $1,000. Notably, 70% of Americans still need a spare $1,000 in their bank accounts. By possessing $1,000, you find yourself among the top 30% of the country in terms of financial stability. Furthermore, only 50% of this group opt to invest their money, placing you in the esteemed top 15% of individuals poised to make wise use of their hard-earned money. Before I begin, make sure you drop a like on this video, subscribe to the channel, and turn on notifications via the bell icon to be notified whenever a new video from us comes out. For the finest finance tips, make sure to subscribe to our channel. Get rid of debt. Eliminating the burden of your outstanding debts is of utmost importance. Debt acts as a significant obstacle on your path to achieving financial independence. Whether it's your car loan or mortgage payments, it's crucial to eliminate these financial obligations as soon as possible, allowing you to channel your money into investments that offer attractive returns proactively. Take a moment to reflect. Do you need that new pair of shoes? Or would it be wiser to settle that lingering credit card balance that has gone unpaid for months? Making sound financial decisions begins with erasing the debt linked to your name. Over time, debt can impede your saving strategies, preventing you from amassing a substantial sum to bolster your investment portfolio. The return rate is an impressive 120%, consisting of a dollar-for-dollar return plus compound interest. This represents the most favorable investment option when compared to others, considering both the return rate and risk profile. For individuals burdened by debt, prioritizing debt repayment is paramount. By clearing your outstanding obligations, you effectively double your investment capacity, achieving two goals simultaneously. High-yield savings account. A high-yield savings account is a place to deposit your funds and earn a more favorable interest rate compared to a conventional savings account. The interest rate on a traditional savings account is so meager that placing your money there could be more worthwhile. Instead, striving for a top-tier savings account that offers a substantial return when you eventually withdraw your funds is advisable. While a traditional savings account typically yields a paltry 0.8% interest rate, a high-yield savings account can provide a rate ranging from 2% to 3%. This type of investment will outperform your standard savings account, meaning that even if you start with just $1,000, you can anticipate your savings growing over time. Considering the minimum inflation rate of 2 to 3%, keeping your money in a regular savings account would result in an annual loss of approximately 1%. Government bonds. A government bond represents a financial instrument issued by the government as a means to raise funds for supporting government expenditures. To illustrate, when the government needs financing for a project, such as road construction, due to insufficient funds, it acquires a loan from an investor who is willing to invest their money. In return, the government issues a document promising to repay the principal amount and specified interest over a defined period. It's crucial to note that prevailing interest rates notably influence government bonds. These bonds are regarded as the most secure investment among the options available, as there is virtually no risk of default, and the government is ultimately responsible for returning the invested capital. Regarding the amount in question, $1,000 may not suffice for constructing an entire road project, but it remains a sum that can be invested in government bonds. The bond market, supported by government backing, is considered a suboptimal investment choice due to the substantial difference in returns compared to stocks or index ETFs. Even with occasional corrections in stocks or index ETFs, bonds still offer relatively low returns, with an annual return rate of only 2.5%. This makes bonds a less attractive investment option. Individual stocks. Due to the considerable risk associated with investing in stocks, a lot of people decide against doing so. The easiest method to convey high risk and high reward is through stocks. Government bonds are almost entirely risk-free when compared to stocks. However, there is always a danger that a corporation will collapse when discussing individual stocks. A stock's decline could be attributed to numerous things. Apple's growth over the previous year was 80%, whereas Tesla's growth was 721%. This informs us that because there is little potential for growth, investment in Apple carries a low risk and a low reward. Never would you have imagined that Apple's stock would increase by 721%. A business the size of Tesla may anticipate a growth of this percentage. Individual stocks have a low yearly return of 30% and a considerable risk. Get a 401k match. If your employer offers a sponsored retirement account in the form of a 401k, then that's another investment route you can look into. If your employer matches any contributions you make to your account, that's a win-win for you. For instance, some employers will match 50% of your contributions up to 4% of your pay. Therefore, if you contributed 8% of your gross compensation, the employer would immediately contribute 4%. It makes sense to do so because this free money is some of the simplest money you'll ever earn. Index funds. The concept of a stock market is how much loss you can take without losing your mind. If the $1,000 are all you have in your bank account, then investing it in the stock market isn't the wisest of options. But if you have backup money, you should try your luck in the stock market. A way you can invest while also minimizing your loss is by investing in an index fund, mainly the S&P 500 index fund. This fund tracks the top 500 U.S. companies where some companies might fall, but most usually propel towards growth. According to historical data, the average return of the S&P 500 per year has been 13%. So if you plan to invest in index funds with just $1,000, your investment might be well spent. Commodities. Trading commodities like gold and silver present a great opportunity, especially when they trade at a lower price. Commodities such as gold and silver provide you with a wide scale where you can invest your money. Gold and silver rarely show a drop in their prices, which is why it is another safe investment on this list that presents you with the lowest risks. Investing in commodities means you are usually investing in future contracts. A long-term commodity that will bring you good returns should always be looked upon as an option to invest in. With $1,000 in your hands, gold and silver are safe and viable options you can invest in. The annual rate of return on commodities is 7% annually. It involves medium risk, so investing in it with the right knowledge is better. Trading cryptocurrencies. One of the hottest topics in investment today is cryptocurrency. While trading cryptocurrency might seem risky, it also brings with it a high reward. There are several platforms where you can trade cryptocurrencies as well. But before getting into the entire process, you must educate yourself in all the basics this field offers. You only need to invest your money with prior knowledge of something. Even if it is just $1,000, you can invest in a staggering number of cryptocurrencies right now. Around 3,000 are in existence, but only a few of them matter. The most important one is Bitcoin, of course. There are several trading applications that you can use to trade cryptocurrencies, and $1,000 is more than enough for a test run into a crypto bubble. Cryptocurrency is a game of high risk, high reward. It is risky to invest in it, but the returns stand at a staggering 50%. Portfolio diversification. Portfolio diversification, or asset allocation, is investing your money in different asset classes and securities to minimize the portfolio's risk. If you invest all your money in a single security, everything will be on the line if that security stutters even one bit. As long as it is performing well, then everything will be fine. This is where diversification comes into play. You need to divide your investments over a range of securities to ensure you get the best returns from every direction you invest in. Ray Dalio's all-weather portfolio is an excellent example of portfolio diversification. Make sure to check it out. Everyone has a different risk profile, which changes the way a person carries out diversification in their investment. But regardless, having an asset allocation is key to becoming a successful investor. You could choose ETFs, stocks, dividends, cryptocurrency, etc. If you enjoyed this video, give it a try. And be sure to subscribe and turn notifications on to be notified when a new video comes out so you can receive all the latest financial tips. And if you know someone who would benefit from this video, please share it with them. $1,000 might be a small amount in the investment world. Still, you can start with the above-mentioned methods, including getting rid of your debt by investing in bonds, cryptocurrency, and commodities. You will also get to learn quite a lot of things about financial knowledge along the way, So you are investing these $1,000 in yourself. You can even play it safe with a high-yield savings account that will bring you a fixed return after a certain period. The possibilities are endless, but only if you think outside the box. That is all I have for today's video. Make sure to comment below on what you learned or how you plan to apply what you've managed to learn in the video. I will see you in the following video very soon.